So today's webinar will be much more on what happens within supply chain planning and what happens within financial planning, and the integration between these two plans and our observation from the past 15 years working in this field for manufacturing companies. So Solventure is active already for 15 years in that domain, and we will start actually this discussion, this open webinar, I would say, from one of our observations from the past 15 years. Today, I say open webinar. Why? It will be an interactive webinar. We will actually have some material that we bring into the discussion, but also some interactivity that we seek with this audience. And we have quite a big audience today on the call, and how we will do that interactivity is through Mentimeter. Later on we will have more practicalities, but take your phone with you. You will be asked to go to a certain URL where you can actually answer a couple of questions. So we're very eager to actually have some interactivity in this webinar format rather than a very dry presentation only. We will dive right in, and we'll start with that observation that I talked about. Well, what is one of our observations for the past 15 years working with manufacturing companies is that we see planning islands appearing within these companies. And yesterday I asked our dear friend of ChatGPT to actually make a visualization of that, and that's what is on the right side. Different islands that exist because in different parts of manufacturing organizations, different types of planning needs exist. Planning needs within a finance department, planning needs within a supply chain department, within sales, within marketing, within HR, for example, workforce planning. And what we see within those companies is that they actually have disconnects between these different types of planning. And we see departments, different functional departments, that to seek to actually professionalize their own processes and actually limit their scope and limit their initiatives, their projects to their own scope. So we see supply chain departments launching RFPs for supply chain planning software. We see at the other end of the spectrum sales teams launching requests for proposals or initiatives which are much more on the sales forecasting or CRM side of things. But we see that is actually creating islands of sub-optimization rather than creating an interconnected planning environment. So not only on these initiatives, but also on how it's being designed. When we design a planning process, we often see that we started from within one functional domain, and that those design exercises happen within isolation of each other. So we really need to motivate different departments to engage with other functional departments when they are designing their supply chain planning process. Go and talk to the sales organization, go and interact with the financial planning organization or the finance organization on what are the different levels of interactivity. It's also, and we plead guilty there, it's also driven by the market. We have system vendors and system integrators that actually are very focused on their own functional scope. They push their functionality and what parts they are strong themselves. They are not necessarily taking a very broad perspective on what we would refer to as enterprise planning. Therefore, we see few solutions actually having a very broad scope. And if they have a broad scope, they don't have the same level of depth and expertise in each part of the solution. And the last part is really about architecting that planning landscape, that interconnectivity is really embedded within the original design. So that's our observation. That's also an evolution. That's also where we plead guilty, but that we see that there is a need for change, because these islands of planning, they actually create a number of effects that are very detrimental, and definitely in today's time. For example, one of the effects is that there is a duplication of efforts. We see supply chain teams coming up with processes to define a sales forecast, whereas financial planning teams would come up with processes, separate processes to come up with a financial forecast, and that efforts to come up with forecasts are being duplicated. And then we go to the last bullet point. It actually also, in a lot of cases, creates two versions of the truth, or even two truths. It's like finance would refer to their latest financial plan, and supply chain would refer to their supply chain forecast. So that cannot be effective in today's times in order to quickly and effectively take decisions. When supply chain planning or operational planning is not linked to financial planning, it can also not lead to very accurate financial plans. And by creating planning islands, we actually facilitate gaming between departments. So supply chain can play a game towards finance, finance could play a game towards supply chain. So that's also very detrimental in collectively across departments creating very strong decisions. That's the observation and the negative effects that we would start from, that we see within today's marketplace. And today we will actually facilitate the discussion, but also come up with a different landscape with a broader view on enterprise planning, and also on how to bring it into practice, how actually supply chain planning and financial planning are natively are actually well equipped or well designed to actually very strongly work together and be very closely interconnected and interrelated. But before we do that, we'll dive into some interactivity. The interactivity will be with menti.com. I will actually move towards the interface of the Menti application. Let me do that. That's right here. So I would invite all of you to go to menti.com. At the top you see the URL, and then also the code that can be used to enter this poll. That's the code is 24719818. So while I leave different participants connect, I will actually go through a number of statements, and the statements are to be voted strongly agree or strongly disagree. The first statement is supply chain planning and financial planning are disconnected processes. So please answer from your current role, your current organization. Is that the case in your organization today? Excuse me. The forecast used within finance deviates with the supply chain forecast used in S&OP. This is the second. There is no correspondence between inventory projection from S&OP and the working capital forecast. And then the last one is S&OP decisions are not reflected in the financial latest estimates. We're collecting the different answers. You're up to 16. I see we have many more participants in the call, so we'll take a few more minutes to actually interpret the results. Minutes, seconds, I mean. Get to 30. I see it quite balanced, actually. So the first one, I see for the first statement, 5 answers to the left, and then more answers, definitely more answers to the right, with strongly agree, 8 and 10. There are a few people that are extreme, strongly agree for the first statement, but I see that the majority is more on the right side of things, that there is quite a disconnect between supply chain planning and financial planning. For the second statement, Also, it's more at the right. Forecast used within finance deviates with the supply chain forecast used in S&OP. There is no correspondence between the inventory projection from S&OP and the working capital forecast. That's a bit scored lower. And then S&OP decisions are not reflected in the financial latest estimates. Also, more answers to the right towards agree or strongly agree.
But very flat curves, Nick. So you see that there are big differences between different companies. And so, which also triggers a question, because if we are doing very different things in different companies, the obvious question is, why is that? And is that then a best practice situation? And so is one of the situations preferable over the other situations? I think that's also what we are trying to explore here.
Maybe also big differences in maturity between different organizations. Let's move to the second question on Menti. Second question is, what effects do you see due to the supply chain and financial planning disconnect? And we have a very mixed audience today. With the subscriptions of today, we had a lot of finance stakeholders, but also quite a lot of supply chain stakeholders. So we would ask, when you answer this question, start your comment with FIN, FIN for finance, and SC for supply chain, if you rather have a supply chain role. If you have an other role, please put maybe your other role or make an abbreviation for your other role, and then the answer to this question: what effects do you see due to the supply chain and financial planning disconnect? Definitely the high turnover, low EBITDA triggers or catches my attention, which makes suffering of the profitability. See also supply chain financial target setting not in line with operational supply chain plans being made, like very kind of a disconnect between what are the financial plans and what are the operational plans, and that maybe on target setting also triggers the question towards variable pay scheme or incentives. Supply chain inventory increase and shortages at the same time. Duplicate work, wasted time, reconciling numbers, rework. That's definitely a lot of effort is being wasted. Answer from finance, imbalance in cash planning. Increases in inventory due to financial latest plan being lower than forecast in the system. Order failure to meet large orders, lost in time with continuous discussions, missed trust. Trust is definitely a big thing between departments, a mistrust. Stock pots and overstocks. Interesting what stock pots would refer to. Not balanced inventories. Irritation between supply chain and finance teams. Finance planning is not aligned with actual supply chain plan. Setting wrong financial expectations. Useless efforts to explain differences between supply chain and financial views. Okay, quite some negative effects, if you would ask me. Assumptions and decision making is not synchronized. Wrong discussions. Right, something you would like to highlight?
Well, I see a lot of frustration, a lot of wasted time, a lot of inaccuracies and inefficiencies. We will come back to that, and I believe one of the opportunities we see for finance is also that cash planning and the working capital and gross margin forecasting, which I think is certainly the finance opportunity. So suggest we move on, Nick, and try to dig a bit deeper into the integrated planning and how we believe finance and supply chain planning could neatly interact.
Right. Let's take a view on integrated value planning landscape and what would be a different perspective than to start from in order to design an integrated planning.
Yeah. So adding from my perspective here, as Nick already said, I think what we discovered after many implementations is that what we see in companies is that different departments will just launch their processes with their planning software without necessarily thinking through how things could be connected or should be connected. And in my latest book, Rethinking Supply Chain, I proposed a new model for integrated planning, which I called integrated value planning. And if you look at numbers 1, 2, 3, 4, so one is integration of between financial planning and supply chain planning. We will zoom in on that in this webinar. But there's more to integrated planning than just integrating financial and supply chain planning. I would say in a broader term, also thinking through how we connect to commercial planning. For instance, trade promotion planning, which is upright in the marketing planning area. It's also something which in general is poorly thought through. And it's like we only find out when we are implementing planning systems how the integration could work. Well, again, it's work that we have then been trying to do upfront, and it's no longer how this could be integrated, but it's more like how this should be integrated. That's the vision we want to bring. 3 is connection with key customers and key suppliers. Very briefly, we still think this is optional, but with all the variability on the demand side, I believe we need to be connected with key customers. And with the complexity of our current supply networks, I believe we need to be connected with key suppliers. Again, the book contains more details on that. And then number 4 is it's not only about financial information and financial metrics, it's also about what is the impact on our sustainability metrics. And in the latest book, I talk about the social foundation and the environmental ceiling. So how does it impact environmental metrics like CO2 or food loss, and how does it impact social metrics like unplanned overtime in our sites or with key suppliers? That's the broader context. But in this webinar, we zoom in on that integration of financial planning and supply chain planning. And if you ask me, why do I believe that we should integrate those two planning processes? A first reason is because I believe that these two processes already do for 80% the same. And that's what Nick will follow up on in the next slide. But I believe there's a big overlap between financial planning and supply chain planning. That's 1. 2, I often repeat that in the current turbulent market circumstances, I believe it's irresponsible behavior not to give proper financial information to supply chain people. And Nick said it a couple of times, we plead guilty. So also with our customers, I see that a lot of the supply chain planning implementations are still heavily volume driven. And if you look at the volatility we had in raw material prices, in energy prices, now with the tariffs coming up, so asking supply chain to do balancing based on volumes or to make decisions based on volumes, I think maybe that was good enough in the 80s, but it's not good enough for the turbulent market circumstances we live in today. We do see a lot of added value for finance as well. Finance also has a lot of unclarity and uncertainty on where financial results will be going, and we'll try to explain how we believe finance can benefit from a more integrated process. What are we doing today? What I often see is that we are duplicating the efforts. So we have a whole planning process with a planning tool in supply chain, then we duplicate the effort in finance where we have a financial planning process in a financial planning tool, and then we triple the effort by trying to align the two numbers. That's also how a textbook S&OP or IBP process works. And so the S&OP or IBP vision from supply chain is we do our plan, and then we try to align it with the financial plan. And as we've seen in some of the comments before, it's probably highly ineffective because there's duplication of information, there's a lot of double work or triple work. Disconnected planning processes also create the inverse of agility. If I align my supply chain plan with my financial plan only once a month, it means that for a full month, I'm working with outdated information. Again, maybe this is good in very stable market situations, but it's not adapted to the speed we need in planning today. And maybe a last argument before we go into more detail on how we believe the two processes can be integrated, but a side effect I also see in companies is that if sales needs to submit a financial forecast to finance and they need to submit a volume forecast to supply chain, what I also see is that sales will submit something to finance which is relatively conservative, and so they will do sandbagging. And when they submit something to supply chain, they will typically over forecast. Why? Because in sales you can never have enough inventory. So having separate processes also automatically creates the gaming that Nick also introduced on the first slide. So though having two separate processes and trying to align the two, I think is still a common practice. In my head, it's increasingly conflicting, and I increasingly have a conflict with myself that I say, okay, I can no longer defend this as a best practice towards customers or prospects. Instead of positioning it as a best practice, I'm starting to position it as a worst practice for all of the reasons that you mentioned on the comments before. And that's just a general introduction. Nick will go into more detail. And you don't get rich of selling books, but if you want to know more about this framework, so the latest book goes in a lot more detail on the different aspects of this integrated planning. But I'm happy to hand over to you, Nick, to zoom in a bit in more detail on how we believe financial planning and supply chain planning can easily be integrated.
Indeed. Let's dive right in. So we will zoom in on that supply chain versus financial planning. We'll do that very hands-on. So bear with us. It's a slide with a lot of animations. I will actually build up gradually how we come to a budget, let's say, what has historically been a good approach for manufacturing companies to come to a budget. And then we'll also have a view on how it relates to what happens within supply chain and supply chain planning. We'll do that hands-on, with an example. Also, the example is within the book. So the first step in getting to a financial budget is getting towards a sales forecast. And here the sales forecast is a forecast in a monetized forecast, a valorized forecast. So we are speaking about volumes and also what is a price per unit. In this case, we always talk about a specific example, and so there are quantified numbers in here as well. And actually here, this is a small block, but it's a pretty difficult block when we see within companies to come to a volume plan, but then also translate that volume plan into a top line plan, into a revenue plan. But that is the starting point for these financial budgets. But if we translate the sales forecast and we use a material balance or a rough cut capacity planning process, actually we can translate it into a production plan. And here, if we sell over a 1 year 210,000 units, okay, we'll need to have a production plan for the same amount if we want to have demand and supply being balanced. From the production plan, there is typically a translation through the bill of material in order to ensure that we have a direct materials and that we get to raw materials, components that are being used in the production of these finished goods. And by doing that, we can actually translate the production plan also in a direct materials cost. When we do that through the routing, and we want to know how much labor gets into that production plan, we actually translate the production plan in units towards, okay, what are the direct labor hours, the direct labor costs linked to that. Both of those together bring us the direct costs. But in order to get to a full OPEX, and these are again with a number of examples, if you get to a full kind of cost picture, we also have a number of variable overhead costs. So per unit produced, there is a number of variable overhead cost linked to it. So that brings us a variable overhead cost. And then in addition, we have within our production apparel, we have fixed overhead costs. And these fixed overheads are of course fixed, include salaries of overhead of production facilities, rent, depreciation of machines, so that we get in towards a total fixed overhead cost. So these are the different examples. That's the translation from that production plan into the direct costs and the fixed overhead costs linked towards production. So really this example is linked towards manufacturing organizations, of course. The total gives us the cost of goods sold in total, so that's the sum of all of it. And it also gives us a cost per unit, which is typically also for production one of their key metrics in order to realize that cost per unit in actual costing versus the standard costing at the beginning of the year. Apart from these costs linked to the production, we also have G&A costs, sales and G&A costs. The SG&A plan, again, a number of typically quite overhead costs of salaries within the sales organization, marketing organization, a number of supporting departments, rent of facilities. If we are very marketing intensive, also the marketing costs, for example, for advertising, piece of depreciation, and that brings us a total SG&A cost. How do we get from an SG&A plan and that COGS, we actually bring it into a P&L forecast. We actually get from a net sales of here 1.2 million, we add the cost of goods sold, or we subtract the cost of goods sold, brings us the gross profit. We subtract SG&A and we actually get towards an EBIT, earnings before interest and taxes. Now, that's not the whole picture. That brings us to a P&L forecast. That's what is needed within a financial, typically needed within a financial organization. We also have a part of the financial planning linked to working capital, the working capital forecast of plan. And actually, where does that come from? If we know what we are going to sell towards customers, or we have an anticipation of that, we also can translate it through the payment terms and conditions towards different customers, towards an accounts receivables forecast. Then a second part of working capital is linked to inventories, and that's typically the most difficult one for finance to truly understand the different dynamics. But for inventory, a supply chain department is typically much more trained to understand the inventory dynamics. They're typically educated quite well in inventory modeling, in how you can, through statistics, for example, calculate what is the necessary level of inventory in order to meet the demand at a satisfactory service level. But actually, when we have a sales plan and we have a production plan through the material balance, we get to an inventory plan. For finished goods here, when we add the work in process inventory, we add the WIP, that's a second component, and then the third component is typically the raw material or components inventory, and that can directly be translated out of the explosion through the bill of material. We know what we are going to buy from suppliers. What we are going to buy can actually be easily translated into a projection of the raw material inventory and bring us that raw material inventory plan. In order to complete the working capital picture, we need to add the last component of working capital, and that is, of course, the accounts payable. So when we link that towards what we will buy from vendors, and we add the conditions that we have with the different vendors, we can actually translate that raw material purchasing plan into an accounts payable plan in order to have a full picture of working capital. And then over a certain period, it's about not only the total working capital, but also about what is the difference in working capital, the net difference, which is then the net difference between the inventory, the accounts receivables, and the accounts payables. What is the additional component that gets added in order to have a full financial plan is to also have a view on the assets. On the assets plan, the fixed assets plan, we have two large components. One is the CAPEX plan, where we have all the future investments or the different projects that we initiate. Might be extension of production lines that are part of the CAPEX plan, or other investments that are being made. That's within that CAPEX plan. And then we have depreciations and amortizations plan, which is the second component of that fixed assets plan. Why is it important to have all of these different components in view or in line of sight? Is actually to come towards cash flow, and especially free cash flow. Why is free cash flow important? Well, free cash flow is actually it's not a nice to have. It's sometimes there is a real minimum constraint for an organization in order to generate a minimum or a good level of free cash flow in order to pay back interests and loans towards banks, and so debt, but also in order to have to actually execute the dividend policy towards shareholders. Is it stock exchange listed, or is it more family-owned shareholders? Also, there is a dividend expectation, and that free cash flow is needed in order to satisfy these, let's say, obligations for the company, and they need to meet these obligations. And that comes from that free cash flow. How do we get to the free cash flow? Is from the P&L forecast. We take the NOPAT, or the net operating profit after tax, which is the EBIT multiplied with 1 minus the tax rate. That brings us, that gives us what we get from EBIT, from profitability. We also need to bring into account the difference in working capital. Do we have a working capital increase or decrease that we envision? And then a third component is comes from the fixed assets plan on depreciations and amortizations which need to add it again, and the CAPEX plans that we have made, and the investments also in order to meet those investments, to actually pay for those investments that needs to be brought into perspective on that free cash flow forecast. Now, for supply chain people, what is that importance of free cash flow forecast, or how do we see finance organizations actually driving their focus and priorities? If there is a pressure on free cash flow, then it needs to come from one of those three arrows. It needs to come either from the EBIT, the difference in working capital, or from CapEx. And then it's about where is the most ability to take medium-term actions in order to, if the free cash flow is under pressure, it needs to happen relatively fast to pimp the free cash flow. Now, if you want to structurally improve the profitability, you need a certain lead time in order to execute profitability improvements within the portfolio towards customers. The CapEx plan, it's already locked in. The investments are being approved, and there is and that's also investment in the future. You don't want to immediately impact those. The depreciations and amortizations are fixed as well. So we see in organizations that have a free cash flow under pressure, that there quickly arises a pressure on working capital, and actually a pressure to decrease the working capital. So in that context, it's also necessary to have a good interrelation between the inventory, which is the most complex part of the working capital, and so to have an interaction between the operational plans which lead to the inventory and the financial expectations with regards to working capital increase or working capital decrease. So that's for a lot of supply chain people, that is where it gets very vague. Not a lot of finance organizations are necessarily very transparent or transparent in explaining why a certain target on working capital is important or is imposed. We see organizations putting, for example, a 50 million euro working capital decrease as a short-term target for the next 6 months. But within a supply chain organization, there is not always a deep understanding of why that is important and where does it come from. And that's actually, so that's the importance of fully understanding this picture, also with the aspect of free cash flow in mind. And then when we have the working capital plan and the fixed assets plan, we can also make a projection of what would be the balance sheet that we expect for the next year or for ending the next fiscal. So now, when we explained all of these different components and the interactions between this, actually now when we think about supply chain planning and sales and operations planning, which of these components are actually natively in scope of S&OP? Actually, when we do the layover of this blue or greenish layover, actually there is a lot that is prepared, that is being planned for already within a solid sales and operations planning or supply chain planning plan. And it's a good translation of that supply chain plan into a financial plan that actually makes this. So this also supports for us, like when your financial planning is not starting or not well integrated from your operational plan, it's just kind of irresponsible. You're kind of just duplicating all of the effort, and you're not integrating well between those two. Bram, anything you would add?
Yeah, maybe just to add from my perspective. So if we do S&OP planning in companies, we do basically the same. We will load BOMs and we will load routings to see how much material will be needed and to calculate material requirements. And we will use routings to see how many machine hours are calculated. So we are doing exactly the same calculations. We are already loading the BOMs and the routings. The only thing we are not yet doing is loading the financial information to make a top line forecast, a gross margin forecast, and a working capital forecast. And it's increasingly conflicting in my head that it's not being done because I told Nick when we were preparing, like with many of our customers, with our knowledge of financial data objects, with our data connector and the accessibility or the access we have to data. Like if we would take many of the S&OP plans, I think we could easily turn them into a kind of a rolling forecast or a rolling plan. And that's leading into your next slide, Nick.
Yeah, indeed. So what is the importance of connecting to your supply chain plan for your financial plans is that you account for capacities and raw material constraints. If you don't do that, supply chain planning these days is done always in a capacity constrained way. So in a financial planning context, it's quite easy to just step over the existing constraints which are physically around in the supply chains. So starting from your S&OP and forces the organization to also think through these different constraints on capacities and also on raw materials if raw materials are being constrained. It should also lead to improved working capital forecast. I see a lot of organizations for the piece of inventory just replicating the past for the inventory piece, the accounts payables and receivables. Then there can still be an improvement objective, like, okay, we will extend or shorten the amounts payables and receivables with a certain amount. But in order to make a good estimation of what is a realistic level of inventory, just relying on the past is not good enough. It's not. You need to think through what is my sales plan, what are my capacities, how is my supply chain network going to change, and how is that going to impact the working capital. Last week we had a discussion with one of the clients. Okay, one of the objectives was to launch new collections, but the new collections were not reflected in the working capital expectations, and it just added millions of euros in inventory by not thinking through that launching new collections requires to have those new collections on inventory and also would have an effect on working capital. So we need to think through these things substantially, and doing that by starting from the S&OP plan should ensure that that inventory modeling is being done in a proper way. And the third one, improved gross margin forecast. If we take S&OP decisions in order to reroute demand from one geographical region or one production site to another, it will impact the profitability. There is a different cost of production in Belgium versus Spain, but there is also a difference in transportation costs. So these things are natively being captured and accounted for in a good S&OP process. So reflecting these S&OP decisions in your S&OP plan and then also connecting that to your financial plan will lead to just improved gross margin forecast and gross margin expectations to prevent what we saw on the previous slides earlier, like when we asked about the negative effects, that it are not realistic expectations on being set from the financial plans. That leads to mistrust, and also people are not accountable or not kept accountable for those unrealistic targets. A last piece before we get into a bit of Q&A, questions and Q&A, is an evolution within a lot of the finance organizations. And the ambition that a lot of finance organizations have is we want to get towards less of a one-off big budgeting exercise. We want to do a more regular financial planning. We would like to have quarterly rolling forecasts, or even we would have the dream to have a monthly financial forecast. Well, actually, achieving a monthly financial forecast, the only way to achieve that is to ensure that you start from an S&OP plan, a monthly S&OP plan, and actually make sure that your monthly S&OP plan gets translated into a monthly financial forecast. What is then the opportunity you have is that your annual activity is actually focused on creating a version of that financial forecast for reference, which is we would call budget, but it's actually creating one copy, let's say, that is being kept as a reference, and that's the comparison for the next year. And then the more heavy lifting on the annual activities is target setting. What would be the targets for the next year? And also what are the variable pay schemes and the incentives that we would like to connect to those targets, and actually have merely the discussion there. What would be good targets on which KPIs and how do they interconnect? Also make sure that we have the resource allocation being done at that moment, and that we actually update the CapEx plan, and that we actually state, okay, in order to execute these plans, what investment needs would there be within the different parts of the organization, and actually make decisions on that, and that is the primary activity on that annual period. Rather than doing a very big budget exercise once a year, or only 2 times a year or 3 times a year, actually get into that monthly cadence. So we'll get to Menti again. So let me switch in order to have a few more questions. Skip to one. So again, the same, normally should be the same code. When we go to menti.com, we still have the code 24719818. The next question is for the finance audience on the call. So if your supply chain, please don't answer necessarily the question. We have a question for supply chain just later on. As a finance professional, I believe that I'm all pro integrating financial and supply chain planning. Strongly agree. No, let's wait. Strongly disagree. Okay, very interesting. We have an open-ended question just after, so maybe I would invite the strongly disagree to actually bring up the reason why just later on. Oh, we have a smaller audience on the finance side, it seems. So we have 3
with very opposing views. That's exactly what we wanted, Nick. And there's a little bit less finance people on the call, and also in the light of time, I suggest to proceed to the supply chain and then dive into the discussion.
Yeah. As a supply chain professional, I believe that I'm all pro integrating supply chain and financial planning. Okay. There is also here one person at the strongly disagree side, but all see a very different image, much more on the right side of things. See some people still answering right, but it's clear that we're at the far right end. Why are you pro or against a strong integration? Start your comment with your role, fin or supply chain. So now it's the time for those people that have a very clear opinion on against the integration. Maybe also what are some of their objections that you would see. So less financial stress and unclarity. All have to work with the same plan and the same goals. Integration, finance, align forecasts. Alignment of plans, scenarios is beneficial for the company. So a holistic perspective. Supply chain, at the end, the financial numbers can show us how good or bad we are performing for the future. That way we can already take preventive actions. To avoid surprises, should be integrated. One plan used by everyone results in clarity in discussions and clear goals, help facilitate better decision making, look at the same numbers. Just scanning for the contra, but either The solid base integration drives success. It's about as good as possible combining the more proactive supply chain with the more reactive finance. So that's a kind of a statement. Let's to have finance as more reactive. That's definitely an evolution in the finance community to be more forward-looking oriented. There are initiatives taking finance as a business partner, trying to drive much more forward-looking initiatives. Okay, I see a lot of pros. And then Q&A, we are a bit over time already, but we have some time, Bram and I have some time to take questions. So now is the time. The question I always wanted to ask is, now,
Yeah.
Bram.
And there were some questions in the question box already, which I already answered. Like one of them was, what is the sales forecast for an engineer to order business selling capital goods, related services and life cycle services? So in a certain sense, it's a more complex forecasting question, but I answered you. Yeah, still you probably want to understand what type of capital goods or projects do we think we are going to realize in the next year. And again, that's important both from a financial perspective as from a supply chain perspective. You always have the dual need, so it will be more complex, but I think the essence stays the same. Have you picked this question? Yeah.
We have a question: who should lead to solve this issue? Should it come from, I would then, finance as an organization or supply chain? Who should take the lead?
Yeah, I'm less concerned who is taking the lead, as long as it's being done. And I think I also believe in the end the needs are a little bit different. And we had a discussion on that yesterday, Nick, as well, that supply chain is making a plan and finance is taking a commitment. So if supply chain is starting the initiative, in the end, finance will still say, okay, maybe we will plan for a sales revenue of 120 and plan the materials and plan the capacities and the people for that. But towards the markets, I might still only commit to 115. So in the end, the process will need to serve both outcomes and both departments, and whomever is taking the lead to do this will need to be willing to acknowledge that and take the different needs and outcomes into account. That would be my thought on that.
Also, there needs to be the willingness to handle the mistrust between the two departments.
Mm-hmm.
So, it's also the responsibility of a management team. So as a management team, you should actually make sure that your different functional departments work together. So it's actually the courage that you need to have within an executive leadership team to actually drive this integration. So yeah, I think supply chain and finance should co-own this depending. Also triggers the question on organization structure, where is supply chain reporting into, which might differ from organization to organization. Maybe a next question. We have an R&D intensive product with a cost price of 500K. It is very hard for us to estimate the impact on inventory, sales, supply chain. How is it done in industry?
Yeah, that might be the reference again also to that capital goods. I think in general, it's easier if you're selling a relatively commodity product from the shelf, because the predictability will be much higher. It's about, and if you have many products and many customers, the statistics are more at play. When it's more one-off, yeah, it's typically more project driven, and I think the whole process becomes much harder. But in your company also today, it's already done. Finance will need to make assumptions on where the business is going and what any cash requirements would be. Supply chain will need to make assumptions on which type of materials to procure and maybe what type of capacities to reserves at third-party manufacturers or for sub-assemblies or something like that. So we are already doing planning efforts, and for sure in this type of industry, the planning is even much harder. But that doesn't change the fundamental thinking that disconnecting the plan will never lead to a better outcome. So I would say consolidating the knowledge and aligning the different plans still seems the way to go. And I would certainly be happy in a follow-up call to dig a bit more detail in the type of supply chain we have here, because and also to look into relevant benchmarks.
Yeah, it also triggers here how to deal with the uncertainty, the inherent uncertainty, and also creating different versions of a plan for when the outcome of a certain R&D investment. Will it work in the market? Yes or no? I also almost feel this here. So how do you reflect that, and how do you manage that uncertainty in your financial plans? But again, there it's much more on how you manage for that, rather than it will be 2% up or 3% down. You will need to manage and reflect that inherent uncertainty, and then you need to balance out the uncertainty with other opportunities. Maybe a next question. I understand these conflicts. For many years, I fully support integration, but what function do we need in an organization to make this happen?
We already answered that. So for me, finance could be leading, supply chain could be leading. I think it's really more a matter of creating a joint awareness and a joint initiative and a joint plan. That's also what we are doing. Like when we are being brought in by supply chain, I will ask the supply chain people to get to the table with finance. And if we are brought in through finance, I will ask the finance people to bring us to supply chain so that we can look at the common needs and solve both needs in one go, rather than doing two tools and two projects and then trying to realign the numbers afterwards.
Maybe
that's probably the trick.
The last question, maybe, because we see we are at the turn of the hour. Is there specific software that supports this? Most of the software focuses mainly on sales and operations planning, but forgets about the financial parameters. Which software do you recommend from best practice? But I would take a stab at it. For me, the most important is to actually deal with the disconnect in design, disconnect in architecting and overarching process. So for me personally, I don't target that on the short term it needs to be a single software solution. I think in the mid-term the market should and will evolve into that direction. The market is evolving towards enterprise planning software solutions. But on the short term today, there are software solutions being implemented for S&OP, very good solutions. There are solutions being implemented for financial planning, also very flexible solutions, very good solutions for planning, but they're not integrated in any meaningful or good way. And that's just the activity that companies should already deal and address with now, rather than waiting for the, let's say, software market to fully evolve. And I'm definitely always open for a follow-up call on more insights on the market. But Bram, what would you add something to that?
No, I'm fully aligned with what you say. I'll let you formally close, Nick.
Okay, thanks all for today's webinar. Looking forward to host you on a next webinar of Solventure. Always happy to interact offline, so please visit our website. You can have all the details to interact with us there or connect with us on LinkedIn. Thanks all and have a very nice day. Bye-bye.